With the fiscal cliff looming less than a month away, you might think that certain sectors would just be getting hammered right now. And I'm not just talking about the obvious ones like defense. Given that the defense budget will be cut dramatically if our leaders don't reach some sort of compromise. Take retail. If we go over the cliff, something that I've been telling you as of this weekend seems more likely by the day, not less, that will deal a huge blow to the purchasing power of most Americans. Think about it. Tax rates go up. The payroll tax holiday goes away. Unemployment benefits expire for millions of people. And that's not even accounting for all the layoffs that will likely happen as the government cuts spending and business gets more cautious. Put it all together, and unless we get a deal, it's clear the consumer's about to get squeezed. I mean, I don't know any other way to look at it, which will be bad news for the single biggest consumer play out there, which is retail. So even though we're having a real good holiday shopping season that I've seen so far, Manny Tirico from PVH has told us that, you'd expect the whole retail cohort to be in trouble. Because once the holidays end, things could get a whole lot worse. And it's not just a fiscal cliff. There's been a ton of discouraging retail news at the big picture macro level. 2 weeks ago, we got aggregate retail sales numbers that showed a 0.3% decline. The Commerce Department reported the U.S. consumer spending declined by 0.2% in October. Last Friday's GDP revisions indicated that growth in personal consumption had decelerated to just 1.4%. These are not encouraging figures. Incomes are flat, spending is down, and to top it all off, Hurricane Sandy shut down stores in the most populous and in many ways the wealthiest parts of the country, the Northeast, for days, in some cases for weeks. Even though we've had some very positive numbers from individual companies like Lowe's and Home Depot, when you combine the litany of negatives with the fiscal cliff woes, you think retail would be in the proverbial...
the house of pain.
Oh, or at least the group would be flatlining. Yet that hasn't been happening. The retail cohort is exemplified by the RTH, which is the Market Vector's retail ETF, has actually been performing astonishingly well. Well, I mean, come on, we got to figure this one out, don't we? Does it make any sense after all those numbers I gave you? That's why tonight we're going off the charts with the help of Ed Ponsi. He's the managing director of Barchetta Capital Management. And my colleague at realmoney.com, whom I just love. And we got to figure out why this retail thing is so strong. We got to learn what the charts are seeing that the headlines seem to be missing. Now, if you remember, one of the reasons why I went back to Ed, he is the guy who nailed the positive direction totally against the grain of the euro. Back in early September, he called a bottom in the euro, for heaven's sake, right before the big German high court decision on the European bailout, and that started the currency spiraling much higher. And according to him, according to a guy who went against the grain then and was right, when you look at the market from a purely technical perspective, meaning based on the charts and not fundamentals, retail might actually be the most attractive area to own in this whole market. All right, just look, you remember here. Look at this daily chart of the RTH. This is the Market Vector's retail ETF, and this is an excellent proxy for the whole group. It really does work. You can see that after retreating from its highs from the year early in October, that was the high for the year, okay? The RTH bottom November 21st. This is this spot right here. And since then, it has come roaring back. Now, Ponsi points out two important things that happened the day the RTH bottom. First of all, the ETF completed an almost 50% pullback. So here, see, this is the 50%. Put it almost 50% pullback. Excuse me. Okay? Of its recent rally and a 50% retracement like we got there. That is one of those key levels where technicians think it's almost a security. Security will often change course when you get down to 50, okay? That's a key fulcrum turn, like a seesaw. The second thing has to do with the moving average convergence divergence indicator, or as we call it, the MACD at the bottom of the chart. Here it is, moving average convergence divergence indicator. This is a momentum indicator that's used to detect changes in a stock's trajectory, not after they happen, not during they happen, but before they happen. So it's useful to you and me. On November 21st, Ponsi says that the MACD indicator gave you a classic buy signal. That's where the black line crosses over the orange line, okay? These two things catapult the retail ETF back toward its high for the year now. Through this whole period, the RTH has stayed above, comfortably above, the 200-day moving average. Now, there, MA is moving average. It's the red, okay? And this is how it stayed. Remember, it's never took out the 200-day moving average. That's a very important because it's a long-term measure of the ETS trajectory. When I was in the game, I used to use the 200-day as my benchmark. A few days ago, we got to Ponsi calling a very bullish development, when it also crossed above the 50-day moving average, a much shorter term measure of its trajectory. Not one that I care for, but that's okay. I'm not the chartist here. When that happens, chart followers of all stripes tend to jump on board. Another point about this chart, Ponsi notes that the RTH is only about 1% below its all-time closing high right now, which means there's very little resistance if it can break out above its current price. Meaning if the index goes a bit higher, well, hey, it could be smooth sailing for as far as the eye can see. Wish I were taller. Anyway, doesn't everybody? Well, I don't know, LeBron. I mean, he probably thinks he's tall enough. Anyway, Ponsi says he would own the RTH right here. And he'd add to his position if we got a couple of developments that you can see on this next chart. Let's go to the ETS hourly chart. That's a chart where each tick is an hour of trading. I used to love to play with these. Ponsi wants one of two things to happen. Either the RTH breaks out above 46. All right, that would be that Nirvana land going to just above the all-time high. That's real breakout, Phil. He thinks that could be the catalyst for the next leg of this rally. Or conversely, he'd also be a buyer if the RTH pulled back to around 45. Now, pay attention to this. This is really important because that's where it went out today. This $45 level has acted as a ceiling of resistance throughout November. Kept on bumping here, right? But once the stock breaks out above resistance, it tends to become a floor of support. This has now become a floor before it was a ceiling. We already saw the RTH pull back to slightly below $45 and then rebounded from there yesterday. Well, get this. Today it fell to $44.94. Believe it or not, to me, I was worried. I mean, I called Ed right before the show began. He says, listen, it's right in the sweet spot. This is where he says he'd be a buyer. He believes the floor will ultimately hold, and the RTH could be primed for another rebound. He thinks this is a good sign. One last point. When you look at the individual components of the RTH, there's a huge disparity between the winners like Home Depot and the losers like Best Buy or JCPenney. However, Ponsi is encouraged by the fact that there's enormous diversity among the winners. Home Depot and Lowe's both made year-to-date intraday highs yesterday. So did the best-of-breed supermarket Kroger, apparel retailer Limited Brands. That suggests to Ponsi that the retail sector should remain resilient as we move forward. Again, I was challenged, worried that we didn't close above 45. Ponsi isn't worried. My view, though, look, I'm more concerned about the fundamentals here than the technicals. And that means I worry more that we could have situations like the Gap today. Did you see that? It got hammered just on rumors of weaker sales. Or like Walmart, which missed its quarter the last time it reported. I'm more concerned about those than the positives you might get from the Home Depot, the Lowe's, the Limited, and the Victoria's Secret there in the Limited. I don't know, it's another channel, I think. All right, here's the bottom line. There are plenty of very real worries out there, especially the fiscal cliff, which concerns me greatly. But even in this grim environment, you can still find entire sectors that are holding up better than you might think. And Ponsi's work from Barchetta Capital with the RTH says the pullback in retail may be just the moment that you want to pull the trigger to this key sector index. Wouldn't that be something? Stay with Cramer. We'll be right back.